All right, good afternoon. My name is Neelam Hamir. I work on the business development team here at AAM. Before we get started, I wanted to touch on a couple things. The presentation should last about 30 minutes. We encourage questions, so please type your question in the dashboard in the upper right corner of your screen. We are also recording this, and it will be posted onto our website. We will send a note out once that has happened. So our presenters for today are Pete Wardala. He is our insurance strategist here at AAM. He is responsible for a lot of AAM's modeling analysis and asset allocation work. He is also responsible for preparing educational materials about the insurance industry, including one of his most recent thought leadership pieces focusing on the MPL industry, which he will talk from today. We also have Marco Bravo. He is our lead MPL portfolio manager here at AAM. Marco will actually also be attending the upcoming MPL conference in Portland in May. So with that, I will hand it over to Pete, and he will talk about some of the trends that we are seeing in the MPL industry.
All right, thank you, Neelam. As she said, I'm going to start out today talking about recent financial performance for medical professional liability, or MPL insurers, and then smoothly hand things off to Marco to talk about investment markets and how those fit into the overall picture here. So we start out by just walking right up to the elephant in the room. The MPL industry has seen a steady, gradual decline in overall returns to surplus for going back about 10 years now. And while returns are generally still positive, they're significantly less so, especially in a context of an overall P&C industry typically getting 5 to 10% returns on surplus per year. For reference, there's going to be a number of graphs here with financial statistics. These show the median and also the 25th percentile to 75th percentile range for a composite that we put together of 97 monoline MPL insurers. These companies represent about half of all MPL premium, with the other half mainly consisting of large multi-line companies like Berkshire and CNA. So this is our 97 company composite. That's the median and the middle two quartiles. So this decline in returns has been driven by a variety of effects, and we're going to be getting into some of them in some detail today. Generally, the upshot has been a degree of higher payouts on claims in a context where pricing has remained relatively flat, which has pinched underwriting profits in between. There's been significant changes to both the level and composition of investment returns over this period as well, and we'll be talking about that a little bit later. Now, the good news here is that the results from the last couple of years suggest that this downward trend in returns, which has been pretty unidirectional for a long time, as you can see there, seems like it's finally reaching an inflection point, and that the industry may be ripe for a change in fortunes here. Now, the last one of these inflection points was in 2010, which, probably no coincidence, was also the year that the Affordable Care Act was passed. And while it does sound like healthcare is going to be an important issue in next year's elections, it remains to be seen if there will be any new legislation coming down the pipe in maybe 2 or 3 years' time, and whether that might be an ultimate catalyst to shake things out of the current regime. Also, whether that would ultimately be a positive or negative if it did happen. So here we look at the trend in combined ratio for our composite over the last decade or so. Now, for MPL insurers, one thing that's noteworthy here is just how narrow that range is. Certainly a comparable graph for, say, homeowners insurance would show a lot more volatility from year to year. This has historically been a strong selling point of MPL insurance, that it is relatively stable. And for a long time, it showed consistent underwriting profits every year as well. But as I mentioned, the underwriting profitability has slowly deteriorated over time. And from 2016 on, we now see the median MPL insurer in our group no longer posting an underwriting profit. However, since that point, results have been effectively flat over the last couple of years. And this suggests that there's been some adjustments in underwriting strategies made which have at least stemmed the gradual leakage of underwriting profits, if not reversed the trend. It looks like a big part of this is related to reserving policies, and that's what we will get into on the next page here. So loss reserve development has been a huge contributor to MPL underwriting profits for a long time. There's been a long pattern of favorable reserve development year by year. This graph shows for each year, it's the reserve development in that year as a percentage of previous year's earned premium. So it's effectively the number of percentage points added to prior year combined ratio due to loss reserve development, with a more negative number being more favorable. So again, as you can see, this has been very favorable for a long time, but with a pattern of smaller, say less favorable reserve releases over time, with that trend continuing up until about 2016 and becoming flat thereafter. MPL is a relatively long-tail line. We calculate that industry average reserve duration is somewhere in the 2 to 2.5 year long range. So it can often take a few years to actually see just how profitable a given accident year's underwriting was. And so also it means that reserve development is a very important part of the overall underwriting picture. The reason that we see this favorability of development declining has a few reasons behind it. Certainly medical cost inflation is a big part of it. Higher jury awards has been a trend going on for a while now. And also the consolidation of healthcare providers in recent years has made it difficult for MPL insurers to raise rates. These have mostly stayed flat in recent years. We were looking at a survey from Medical Liability Monitor suggesting that in the last 4 years, from 65 to 75% of MPL insurers have kept rates flat year over year, with the remainder of them pretty much evenly split between increases and decreases. So really not much room for rate increases there. But again, it does seem like something has changed around that 2016 time period and things have begun to stabilize. One second here, we're technical
Gotta love
adjustment.
technology.
Okay, so obviously another important part of the underwriting picture is whether the entire premium pie for the industry is growing or shrinking. Here we see significant variation among individual companies in each year, but that the median MPL insurer has seen their premiums lie roughly flat for the past decade. And again, this is reflecting changes to the healthcare delivery model in the U.S. With the after effects of the Affordable Care Act, consolidation of healthcare providers, and the increase in competition. One result of this is that the scale of operations for an insurer is increasingly important when it comes to negotiating for business with large hospital and provider networks, which are providing a larger and larger share of the overall healthcare in the United States relative to the solo doctors operating their own practices. And as you'd expect, this could ultimately lead to MPL insurers pursuing M&A of their own, or in some cases, insurers for whom this is not a core line of business, they may exit the market until harder conditions prevail. Thus far, we have seen fairly stable and low amounts of M&A in this space, roughly 1 to 2 deals on average for the last 5 years or so. So we haven't seen pace of these deals accelerating, but this is definitely something to keep an eye on as we go forward. And we continue to see competition over a relatively fixed pie.
Pete, before we go on, we've got a question. It says the slide shows the range and median of premium growth for these insurers, but what about the total volume of premium? And is there an upward or downward trend with that number over time?
Oh, okay. Yeah, you can't really see the total amount from this graph. So this composite had a total premium written volume of about $4.25 billion in 2018. That was about 2% higher year over year. That's actually the highest rate of growth they've had in a while, though. The average rate of growth of that number has been very close to zero in all of this, the last like 5 years. Over a 5-year time period, the total net growth has been just 3.5%, and that's not annualized. That's total in 5 years, or 3.5%. So really a very little net change, and there's been some years where it's actually shrunk a little bit. For reference, over that same time period, the overall P&C industry saw premiums written grow by about 28%. So clearly a very different picture facing this particular subsector. So now we're going to take a little look at the investment side of returns. Obviously, an important part of earnings for any insurer, and MPL is no different. And there are a few trends on this side that are worth highlighting. Yields on bond portfolios, which make up the core of MPL insurer portfolios, just like virtually any insurers you could name. The yields on these bond portfolios have generally trended downwards for most of the past decade. As I'm sure everyone is very familiar with by now, that's due to low prevailing rates for reinvestment as prior bonds run off. And for a long time, that's nibbled away at investment income year by year. The good news on that front is that we finally have, between some Fed rate increases and slightly rising expectations of inflation, over the last couple of years, we've actually seen the trend reverse a little with some better reinvestment rates available. This graph here is showing total investment return, which includes both bond yield and also returns from equities flowing through to surplus. So, but looking at considering just the bond yield part, after many years of declines, the gross yield on bonds rose from about 2.5% in 2016 to about 2.85 in 2018. So some signs of life, and it's interesting that coincided again, where that 2016 year seems like a year when some of these patterns started to turn around for the industry. Most of the volatility, though, on this graph is due to equity returns, which have generally been very strong. It has been a definite bright spot for P&C insurers generally in the last 10 years. There has been some volatility. 2017 was an especially good year. 2018 actually saw some downside for the first time in a while, but equities, making up the main risk asset or surplus growth strategy held by these insurers, has been a material contributor to returns. And actually, we can, speaking of equities and asset allocations generally, the next slide gets into a little more detail on that. So this actually shows equity holdings for our composite, shown as a percentage of surplus for each year. This is a more relevant measure than showing it as a percent of investments, because this illustrates the level of surplus volatility that these companies are willing to take on in pursuit of surplus growth and higher returns. Here, again, we see a definite trend that eventually stabilized and has perhaps started to reverse. Starting in 2010, with the memories of the financial crisis right in the rearview mirror, allocations were quite low. They did trend upwards, partly due to just natural organic growth. That was a period of generally strong returns in the market, and also due to increasing willingness to take on some more of that investment risk again. We see the median level of equity exposure peak at about 15% of surplus and remain basically flat thereafter, with year-to-year variation. It seems like it's mostly just caused by how the markets are actually doing every year. Notable though, this 15% of surplus number is below average for the P&C industry overall, where that might be closer to 25% of surplus or so, reflecting a somewhat more conservative than average preference for asset allocation. Though again, we do see a lot of variation across individual companies there. Right. So, just given what we've seen about profitability on the underwriting side, we would expect that MPL companies may very naturally be looking to tweak their investment strategies and help compensate for challenges that they're facing in the underwriting environment. At AAM, we are investment advisors. We do have a lot of helpful comments to make on that topic, and I cannot think of anyone better to make them than Marco Bravo, who will give us an update now on the state of the investment markets.
Thanks, Pete. I'm going to start my part of the talk with just a general overview of the macroeconomic environment. And this slide here shows that economic growth forecasts worldwide have been lowered. So both here in the U.S. and abroad, just to put some numbers behind that, looking at world GDP growth rates in 2018, GDP increased by 3.6%. That's expected to decline marginally to a growth rate of around 3.3%. Here in the U.S., we saw GDP last year grow by almost 3%, 2.9 to be exact on a year-over-year basis. And for 2019, the expectation is for that growth rate to slow to a 2.4% pace and then slow even further to just below 2% in 2020. So this slowing growth forecast definitely has implications for the markets, starting with central bank policies. We saw the Fed pivot here recently from a more hawkish stance to a more dovish stance, and changing their projections for rate hikes in 2019. Originally, their own projections were calling for 2 rate hikes this year. That's now projected to be 0. And we've seen similar actions or pivots by other central banks around the world. ECB, for example, holding rates steady, definitely affecting fixed income markets and other markets as well. Also has implications if we think about investments in more economic sensitive industries and the potential pressure that a slowing economic growth could have on companies' earnings. Regarding the U.S. here specifically, though, we do think here at AAM we'll see slower growth this year than what we saw in 2018, but we're not calling for a recession this year. We still think there are strong fundamentals within the U.S. economy, those being labor market continues to be very strong. Wages are trending higher, albeit at a slower pace, but still trending higher, and that should be supportive for consumers, which represent just over 70% of economic activity. Speaking about consumers, household balance sheets still seem relatively strong. Financial conditions have improved from the fourth quarter, and capital continues to be readily available for those companies that need it. That's not to say we don't have downside risks. We do for sure, and some of those risks include the slowing growth that we see here on this slide. Recent decline in confidence by both consumers and businesses, although I would say that those confidence levels continue to be relatively high, but we've seen a slight deterioration in those confidence. Trade tensions and geopolitical risks would also, we would classify as downside risk to economic growth. When we kind of view both the positive and the negatives here at AAM, we feel risks are slightly skewed to the downside, and that has caused us to be more cautious in taking risk within our portfolios. Lower growth expectations, limited inflation pressures worldwide, and more dovish central bank policies have had the effect of driving government bond yields lower, as shown on this slide here, especially in Europe. If you compare the yields, and this slide shows the 10-year sovereign government bond yield for these specific countries. You see the U.S. on the far right of the slide. The 10-year yield as of April 16 was 2.59%. When you compare that to, for example, German bond yields, the spread between the U.S. and German 10-year bonds currently around 250 basis points, that compares to an average spread between those two securities of roughly 190 basis points over the last 5 years, and 115 basis points over the last 10 years. So there's clearly a yield advantage that U.S. government securities offer for foreign investors. And we believe this is going to continue to attract capital as the foreign investors search for higher rates and increased returns. And so as capital continues to flow to the U.S., that should have the impact of keeping rates here lower for a longer time period. As we look at kind of non-treasuries and specifically on this slide looking at investment-grade corporate bonds, the credit spread or the yield advantage that investment-grade corporate bonds offer over treasuries, we think today look fair. The graph on the left side of this slide shows the spread for the overall investment-grade corporate sector, with the one on the right showing the historical spread between BBB rated corporate bonds, or NAIC 2, and single A rated corporate bonds, or the equivalent of NAIC 1. And although spreads are off their recent heights, we don't think the yield advantage of owning corporate bonds today are really compensating investors enough for the potential risk of slowing growth. As you heard from Pete earlier, NPL companies are experiencing rising loss ratios, and this could have the effect of causing these companies to look for ways to boost investment income, which, as we all know, increasing investment income requires increased risk-taking. Given the slower growth projections, the risks of slower growth, and what we would view as fair credit spreads, we don't think today investors are really being compensated to increase risk to a large degree. And our recommendation would be one of cautious and really leaving some dry powder available to take advantage of opportunities should they arise in the future and we see wider spreads where you're getting compensated for taking increased risk. So here at AAM, we've been careful in taking exposure in certain industries that are more economically sensitive, like the technology, media, and retail industries, and being very careful when going down in credit, really staying away from the weaker BBB minus names, and if we're buying BBB corporates, staying up in quality BBB plus, middle BBB, and those companies and industries that would be less sensitive to a downturn in the economy. And this is very important today, largely due to the information that you see on this following slide that shows the composition of debt leverage for non-financial companies. And it's clear that corporations over the last few years have increased debt and increased leverage. And so today being cautious is very important given this increase in leverage of corporate balance sheet. What this slide here shows that at the end of 2018, roughly over 60% of non-financial companies have leverage, which we measure as debt to EBITDA, of 2 or greater, versus less than 40% back in 2012. And what has occurred, if you think about debt to EBITDA, EBITDA has remained fairly stable, but it's the debt part that has increased as companies have added leverage largely for the purposes of to fund M&A activity, stock buybacks, or special dividend payments. And this has implications that if we do see slower growth than what is being projected, implications for downgrades from BBB into the BB or high yield category. If we see margin compressions affecting earnings, we would expect to see downgrades occur as well. So again, going back to what I mentioned earlier, being a lot more cautious and conservative when taking credit risk, we believe that's the appropriate thing to do at this point in the economic cycle, and given the amount of compensation that investors are receiving for taking risk. One last point I want to make on tax-exempt securities. You heard Pete mention earlier the composite of 97 NPL writers that we follow. We noticed our research shows that about 11% of those or a large percentage of those companies on average have about 11% of investment income coming from tax-exempt municipal. So these companies continue to have tax-exempt securities as part of their overall investment portfolio. What the graph here on this slide shows is really since the change in the tax laws, tax-exempt securities for insurance companies, specifically P&C and NPL writers, today are very unattractive, even on a taxed-up basis. The graph on the left shows the nominal yield ratio between tax-exempt municipals and treasuries. You see it's at an all-time low given the period that is shown on this graph. And even when you gross up the yield to the fully taxable rate of 21%, the graph on the far right shows for anything less than, I'll call it 15 years or shorter in maturity, that grossed up yield is less than what you can earn in treasuries. And it's only when you get above that maturity range where you're earning what we would call a small spread over treasury. So to the extent that you have tax-exempt municipals in your portfolios, we would be looking for opportunities to sell and reinvest in taxable securities to earn higher yields. So with that, I'll open it up to any questions to either Pete or myself.
Marco, it looks like we've got one. Where does AAM see value in the market?
So the question was, where do we see value today in the marketplace? And really, as I think about that question, kind of go back to what I was mentioning earlier regarding what we view as healthy consumers' balance sheets versus what appears to be over-levered corporate balance sheets. So we today prefer at AAM, we prefer consumer-related risk versus corporate-related risk. So for NPL portfolios, which would tend to have a duration profile, more of an intermediate duration, we would take advantage of more attractive opportunities in asset-backed securities. So these would be consumer-backed receivables like auto loans or credit card receivables. In the short end of the yield curve, they're a lot more attractive than what you could earn in corporate securities. As we move out the yield curve, commercial mortgage-backed securities, senior AAA classes, and non-agency residential mortgages, again, senior AAA classes look very attractive relative to corporate bonds. And again, it's not to say we're not buying corporates, but we're being cautious, staying up in quality when we're buying corporate or adding corporate credit risk to our portfolios.
Okay, thanks. Any additional questions from the audience? Okay, well, thank you for your participation.